Hello, everybody. So I want to provide a quick update on CrowdStrike and Zscaler, which are two positions that I own. CrowdStrike is my bigger position. CrowdStrike is in my top 10. Zscaler is a top 15 stock. For me, I typically see those stocks as going hand in hand. In fact, they do a lot of marketing together and they sell each other together to a lot of companies. As a quick reminder, CrowdStrike is a cloud-based, quote-unquote, antivirus. I know it's not exactly that, but it's a cloud-based antivirus that has the biggest network, the most amount of computer using the Falcon software. And because they have the largest network, they are able to stop breaches before everybody else because they get to know whenever there's a breach somewhere on the network, they know about that and they can update all of the devices that are using the same software. So that's why CrowdStrike is a winner-take-all or a winner-take-most business. That's why, for example, if you look at SentinelOne, it's had a very hard time against CrowdStrike. And Zscaler, really briefly, what Zscaler does is it prevents when you have one computer that is infected by a cyber attack, it prevents the spread of that infection to the entire company network. That's why Zscaler is called Zero Trust Security. Let's say you get a virus on your computer gets infected. Thanks to Zscaler, you limit the damage to one device and one device only, and you don't spread it to the whole network, which is why those two systems, CrowdStrike and Zscaler, tend to go hand in hand. So now that I've made this clarification on a qualitative standpoint, what these businesses do, let's see what's going on. So when you look at CrowdStrike, this is another record smashing quarter, which is why the stock is up 10%. They've achieved a rule of 66 in a world where a rule of 40 is considered good. If you're not familiar with these rules, the rule of 40 means that revenue growth plus the profit margin as a percentage should be more than 40. So for example, a company that grows revenue at 20% and has that has a 20% net profit margin, that would consider to be a rule of 40 SaaS company, and that's considered to be really good. Obviously, CrowdStrike smashes that by well over 50%. And if you look at their revenue growth over this past year, they are up 55% on the ARR, and their number of subscriptions themselves are up 37%. So not only does that mean that they're growing the number of customers above my threshold of 30%, but these customers are buying products at a greater pace than new customers are joining. So this is a company that's really growing both in how many products the customers adopt, and that is also growing in how many new customers come in. So you get exponentiality because you multiply the number of products that customers buy by the growth of the number of customers itself. So you can get quite a bit of exponential growth. Now, looking at Zscaler is a similar story, actually. Zscaler is growing a little slower on the top line, but still well above my 30% revenue growth threshold. You can see they had guided 33% year-over-year growth. They grew at 40%. Now, this is not surprising. We know that all of these companies have been sandbagging. That's why they were cheaper at the beginning of the year. So they grew at 40%. My minimum threshold for revenue growth is 30%. So Zscaler, well above that, but where Zscaler shine obviously is on their margin. Their free cash flow margin was 45%. So if you add that to revenue growth, that leads you to a rule of 80, more than a rule of 80, 85%. And you can see it fluctuates from quarter to quarter. When in the case of Zscaler, their Q1, which for most people would be a Q3, but that's when they close their year. Their Q1 for them is the biggest year. But you can see if you average it out, they're at roughly 70%, roughly growing at the same speed as a CrowdStrike. CrowdStrike grows a little more on revenue growth, but to me, very similar companies. Of course, you look at the stock price. Zscaler is up 5%. CrowdStrike is up 11%. Great trading days for them. And the last thing that I want to update you on is the valuation. So as you know, on this channel, I really like to use my metric that blends both revenue growth and takes into account for revenue growth, as well as valuation on a quote-unquote profitability basis. I use gross margin as my favorite metric because I believe there's a lot of issues when you use net margins or operating margins, and the issue being you count marketing as an expense and you count R&D as an expense. And in my view, for these companies, it's not an expense. Marketing is not an expense. When you sign up a customer, that customer stays 15 years with you. I consider this an investment. So I like to trust my companies to invest wisely any money that comes after the gross expenses, right? After the cost of making the product, after those expenses are removed, that's when I look at profitability. I look at profitability before R&D, before SG&A, and before the general expenses of the business. So, looking at the valuation, what do I get? I get valuation between 50 and 60. So it's a 0.51 for CrowdStrike. So what that means is for each percentage point of forward growth, I am paying a 0.51. So the growth at CrowdStrike right now is a little cheaper than the growth at Zscaler. Because for Zscaler, for each 1 percentage point of revenue growth, I am paying 0.57. I want to highlight that this is cheap, that a lot of stocks that I own, my top position, Tesla, the growth at Tesla, you pay up for that growth. Tesla is a 0.8 right now, as an example. Now, obviously, if you compare the SaaS companies to, say, smaller caps like a HIMS or a StoneCo, companies that are under the $5 billion market cap, you're paying 1/10 of that for that forward growth, but they're riskier companies, they're much riskier companies. We saw an example. I want to make a video about this today. A stock I've scored on the channel before, Rover, which scored amazing on these metrics. We saw an example as to why it's risky, because guess what? Rover got acquired. Right? It's very unlikely that a $30-40 billion company gets acquired. Right? If you're a small $5 billion company, you can get acquired. And if you're acquired, then, it defeats the purpose. Because as an investor, you want to earn the returns. You want to own the stock for 10, 15 years. You don't want some hedge fund to force you to take capital gains when you don't want to take those capital gains. That's not what you want. So bigger caps are safer for that reason. They also have greater inflow of money for institutions. They tend to, I only say tend to because we have had a lot of abnormal volatility, but they tend to be more stable. And I believe the reason why these stocks, which by the way are not, per my spreadsheet, is not the most overvalued stock. Like, for example, Nvidia is a 1.1 right here. You look at companies like the Trade Desk, you're at a 1. You have plenty of companies who are at a 1. So it's not that overvalued. It's not undervalued. It's probably fair value when I look at my spreadsheet. But I want to say, this is cheap, and this is where I'm getting into modifying my spreadsheet and really giving a premium, trying to give a premium to companies that take a risk and give us long-term guidance. Last quarter, 3 months ago, what happened? CrowdStrike updated its guidance. It had a $5 billion guidance 3 years out, and it updated it to a $10 billion guidance in annual recurring revenue between 5 and 7 years. So roughly 2028 or 2029, depending on how you look at it. But in 2029, they should have $10 billion in ARR. That is what they've guided. This gives us a lot of safety in our assumption for revenue growth, because to get to there, they're going to have to grow at above 30% year after year to get there. So this, to me, protects a lot of downside, because you have a stock where the CEO is out there giving us a very long-term guidance, and so you don't have that surprise that many companies had in COVID, where the growth all of a sudden stalls and stops, right? This is not something that the CEO of CrowdStrike is seeing, and the same is true. And by the way, $10 billion in ARR, you can see the revenue right now for CrowdStrike is $2.8 billion. right? So not quite a 4x, but almost a 4x in revenue over the next 5 to 7 years. So if price to sales remains the same, if price to sales remains as depressed as it is today compared to where it was in a low rate environment, theoretically you should get a 4x. Theoretically, if the revenue quadruples and the price of sales stay the same, that's what the theory tells us, right? Then you have ratio compression or ratio expansion, but as interest rates go down, I think the ratios will expand. Price to sales will inflate if the interest rates go down. I mean, that's typically how it works. Zscaler is a little more shy on the guidance, but they have given us a number. So Zscaler's ARR right now is $1.7 billion. That's their recurring revenue right now. They have guided us $5 billion in ARR and beyond. Now they didn't give us a time frame or a timeline. But I think it's fair to assume that it's not a 10-year goal. I think it's much closer to a 5-year goal if you compare the closest peers and how far out the closest peers have guided. And 2024 is next month essentially. So the fact that they released that 2 days ago tells me it's probably a 5 to 7, 5 to 8 year guidance. So again, right there, they are also guiding to a 4x-ish in revenue, and that's the same rationale. If the revenue multiplies by 5, say in a 5-year period or a 7-year period, the return, provided that the price to sales remain the same, the return should be excellent, right? It should be multi-baggers. I believe these stocks will both be multi-baggers. I'm very happy to own them. Right now, lots of cheap stocks right now, so not adding as much to these companies right now, but very happy to own them for the long run, and I'm glad to have exposure to cybersecurity. The world is going cyber, security is going cyber. Brick and mortar is not the type of places where companies are investing in security today. No, companies are investing in security in the digital world. We'll live in a digital world, and these products will be more and more needed as we go forward. And you gotta love the recurring revenue, right? That's also part of a premium. You have recurring revenue. You don't have to fight for every sales. And once the customer's signed up, the sales keep coming back. So this was not investment advice. This was just entertainment. Appreciate your likes, appreciate your subscribes, and have a wonderful day.